Good afternoon, everyone. Anthony Locke with Torrey Hills Capital, and welcome to the Itafos webcast for August 14th, 2025. Hope everyone's doing well, and thanks for taking the time to join our virtual lunch. Very happy to have Itafos on with us today. Many positive developments have happened since we last presented the company, and we're excited to bring everybody up to date on the company's progress. The company, just as a reminder, operates as a phosphate and specialty fertilizer company. The company operates through Conda and Arraias, two mines in production, as well as two development and exploration projects, Santana and Farim. The company's flagship mine, Conda, continues outstanding operational performance, setting a number of production records in 2024. Company just announced earnings last week, and I'm sure they'll touch on it today. And I think everyone will be impressed with the numbers. Company trades on the OTC under the ticker ITFS and on the TSX Venture under the ticker IFOS. Currently trading with a market cap of only about 400 million US. Based on the company's strong underlying fundamentals, we feel there's plenty of potential upside in the stock, which I think will be clear during the presentation today. With us today to discuss Itafos operations and growth strategy going forward is the company's CEO, David Delaney, CFO, Matt O'Neill, and John Donnell, who is the Director of Investor Relations. And welcome. It's great to have you all on today. Looking forward to giving our group an update on the progress the company has been making. It's been very impressive to say the least. But before I turn it over to Matt, I just want to let everyone know, I think you all know at this point the format. If you have a question, just type it into the Q&A or chat box, and we'll make sure that it gets answered. So with that said, I'm going to turn it over to Matt O'Neill. Matt, the floor is yours.
Thank you, Anthony, and welcome everyone. We appreciate your time. We value it very much. Just if we could go to slide 2, disclaimer in relation to the presentation. As a mining company, we obviously have mineral reserves and resources which have been attested by qualified persons under our NI 43-101s. We also provide a market outlook and provide some forward thoughts around that. And as well, we'll just highlight that we report under international accounting standards. If we go to the next slide, just a quick overview of our business. As Anthony mentioned, Conda is our flagship asset, vertically integrated phosphate fertilizer business located in southeast Idaho, referred to as Conda. We also have an operating asset in Brazil called Arraias, and we have two other undeveloped assets, Santana and Farim, which provide great optionality in our portfolio. We'll touch on another asset that we sold last year, Arraias. It was a rare earth project located in Brazil that we sold. We still have two installments for that sale to come through over the next 12 to 18 months. If you could move to the next slide, really three pillars to everything we do. The first is operational excellence, and we'll show our ability to operate our assets as efficiently as possible. Our utilization relative to our peers is second to none. We have significant long-term offtake and supply contracts, which provide stability to the business and do differentiate us in a little way from some of our peers. On the investment side or the growth side, disciplined investment approach. Our focus and capital priorities to maintain our assets to continue to drive performance, and we'll talk a lot about that as we go forward. And investing in projects to either increase the resource base or enhance the quality of our operations. And then finally, the third leg is really the high grading of the portfolio, trying to maximize the value of our foreign assets and then identify other value creating opportunities associated with that, as well as our core business. If we move to slide 5, I think this is really a testament to the whole team at Itafos on how well the business has run, not only over the last 3 years, but probably over the last 5 years since David became CEO in 2020. On the left-hand side of this page, you can see our utilization. It's driven by a couple of things. We still have really good resource availability. The grade of our ore is very, very high. But this is really testament to the philosophy of the company, the support of the board about continuing to maintain and reinvest in our infrastructure and our business. You can see here that we've been operating at essentially about 100% of our nameplate capacity over the last 3 years. And if you compare that relative to others, in the industry. You can see that has been declining. David will talk about this in the market about just overall US supply declining. That's not been driven by us. What's pretty unique about Itafos is we're the smallest phosphate producer in the country. There is one other company, Simplot, who are private, so we don't have their data. But although we're the smallest and probably the most geographically isolated, you can see our EBITDA margins on the right-hand side are the highest in the industry in North America. That's really a function of our high utilization, our great quality ore, as well as our contracts that we have around our key inputs, sulfur, sulfuric acid, and ammonia, as well as our key offtake contract associated with our MAP product, which accounts for about 60% of our sales. If I move to the next slide, it's really been a remarkable turnaround. When David took over in the fourth quarter of 2020, the company had, I think, over 240 million of debt. You can see from the graph on the left, we've been able to completely delever the balance sheet. And that's all whilst building out a brand new mine at Conda, reinvesting in all the maintenance capital that we need. And so over this sustained period of 3 or 4 years, while market conditions have been very, very favorable, our utilization and our ability to operate to take advantage of those has seen the balance sheet successfully delevered, and then really all the investment capital being funded through internally generated cash flow. We've never been better positioned from a liquidity perspective. We have an $80 million undrawn ABL facility, almost $100 million of cash on the balance sheet. And it's required because we have a significant CapEx profile this year, as well as next year, as we complete our H1 NDR mines, as well as our mag reduction project.
Hey, Matt, can you talk about the amount of money you saved in finance costs just between where the balance sheet was versus where it is today?
Yeah. So we have a traditional banking debt structure now. It's a syndicate that's led by RBC. Annual finance costs, depending on where the base underlying SOFR rate is, somewhere in the high 7s or 8%. In 2021, I believe we spent over $30 million in financing charges. And we're probably closer to 10 million this year. So it's been a significant change as we reduce the debt load.
That's great. Thank you.
Moving to slide 7, you can see here relative to some of our peers in the industry, and there's not a great comp for Itafos, just given our size and scale. Nutrien and Mosaic have much larger businesses. You can see that we trade at a significant discount to our peers. We have been catching up, and the stock has performed well over the last 12 months. But there is still a significant valuation discount. Some of that is due to just our capital structure and the float that's available in our shares. But as a team, we're really trying to get out there and promote the business so people understand fundamentally how well it's run and what this valuation gap looks like. With that, I'm going to hand over to David Delaney to go through some of the market dynamics that are driving some of our performance.
Thank you, Matt. I, too, am very proud of what our employees have accomplished over the last 5 years. And as you can see from the graphs, it's very incredible what the team has done, the execution, the discipline, and the operating rate, and also supported by our board of directors. From a crop fundamental standpoint, I think the key point is, the increased government spending is supporting our U.S. farmers and the affordability concerns. If you go back to 2020, Trump was super supportive of our farmers, and I think that will remain through his term. The left graph really addresses total planted acres, and they don't really change dramatically year to year. The big variance really year to year is how many total acres of corn or soybeans will average. In 2025, total corn acreage was 97.3 million acres, according to the WASDE report just a few days ago. The last 8 years, we've averaged planting 91 million acres. It was actually 90.6 last year. So really more corn acres across the country. We had more corn acres in really non-traditional areas like the Delta, the Southeast, Southwest, some areas of Texas. the plain states, the ice states grew more corn. So just corn everywhere. I don't recall a year like this with this amount of corn planted. And to go along with that, we've really had just perfect weather all spring, all summer, right amount of heat units, the right amount of moisture. And the USDA came out Tuesday with a average yield of 188 bushels per acre. For the last 8 years, we've averaged about 176. So I don't think that's going to be the new trend. We'll probably get more back in line with trend next year, but this is just an incredible year of acres and yield. So more acres, higher yield will mean a higher carryout, right around 2.1 billion bushels. We've seen prices for this year go down. The December corn price right now is $4 per bushel. In February, it was $4.75. So been a lot of pressure on the price of corn. But if you go to next year, December 26 corn is at $4.45. Consumption has also been record setting. Exports have been really good, 2.8 bushels without China. Domestic consumption, we're feeding a lot more livestock, record livestock prices. Ethanol has been good. So right around 15.9 billion bushels of consumption. If you go back to 2022, that was closer to 13.5. So lower prices do mean more consumption. I would say corn acres next year will likely be down closer to 90 to 91. Now that will, we're closer to 90, 91. That will reduce carryout as we get back to trend yields, correspondingly better corn prices too. Soybean acres were up this year, but I think next year, they will likely trend up. If you look at carryout for beans, are quite low or much lower than they have in the last few years. And as Trump tweeted on Sunday night, we're hoping China comes back in and buys some U.S. soybeans. And if you think about phosphate application, it's very similar to either corn or beans, so we're not really penalized if there are more bean acres. And then corn stocks outside the U.S. and China are still very slim, so most of the corn is here, frankly. And then U.S. government spending on ad hoc payments is close to the 2020 level, as I mentioned. We're looking at $42 billion this year. Net farm income will be around 193 billion versus 164 the last 2 years. So as you hear about affordability and farmers, I mean, farmer balance sheets are in really pretty good shape across the Midwest. Now you get some of the peripheral areas where they don't yield as large of yields as we see in the Midwest. They're probably hurting a little bit more, but in our major market areas, I think farmers are in pretty good shape. Crop receipts will be down marginally this year, not as much as you might think. With more bushels, that helps. While livestock receipts are up dramatically since 2022, and there's just a lot of corn going into livestock. So fundamentals still look good despite this big crop we'll be taking off this year. Stocks use ratio is still bullish despite these huge corn crop being harvested now through fall. Global stocks use ratio is forecasted at 16.1%, well below historical norms. If you go back to 2014 to 2020, the stocks use ratio was between 18 and 19%. And if you think about that period, we had low crop prices, low fertilizer prices. We're absorbing new phosphate capacity in China, Morocco, Saudi Arabia. It was a tough period. And China went from, not being a big importer in the early 2000s to being a third of global trade. So it was a tough period through those teen years. But the last 5 years, we've been closer to 16%. We have better grain prices. We've had higher fertilizer prices. All of that new phosphate capacity has been absorbed, and there's been very little new capacity added. So China's keeping more phosphate at home for LFP, electric vehicles. They're supporting their Chinese farmers. They're trying to raise their yields, and they only have 25 years of reserve. So really a big step change in the last 5 years, which shows up in our results. In terms of phosphate supply, I think it remains constrained. If you go back to 1990, 35 years to put this slide into context, in 1990 in the US, there were 18 phosphate fertilizer companies. Today, there are 4. There were 22 facilities. Today, there are 10. There was 10.9 million tons of P2O5 capacity. Today there is 7, but the actual production this past year is closer to 5.2, 5.3. And it's just difficult in the U.S. with the way things operate with low grade rock in Florida and a lot of downtime through hurricanes and such. We're really half of what we were 35 years ago. Florida reserves and quality rock has declined rapidly in the last decade. You got low grade rock, tougher to process. Mosaic's importing more Peruvian rock to raise the grade of what they process. And then White Springs is going to shut down in 2030 to 2032, taking more capability and another facility out. I think Chinese phosphate exports has probably been the biggest news. It's been a huge development. First, as I said earlier, China only has 25 years of reserves. I'm actually headed to China Sunday to meet with several of the phosphate producers. I'll learn a lot more, but they are directing more P2O5 to farmers and to LFP. They're trying to increase crop yields. Historically, corn yields in China have been closer to 100 to 110 bushels per acre. So they're really focused on, I think, with the acquisition of Syngenta, better seed technology, trying to improve yields in that country. I know 5 years ago, Goldman Sachs thought China would be a big corn importer of close to 50 million tons. They've been around 20 to 30 the last 4 years. Now, they haven't imported anything to speak of this year. I think they had a big crop. The carryout's a little bit larger, but I don't see them really going away from importing corn. So we'll have to see how that all develops. Let's see. Again, if you look at the last 4 years, they've taken about 3 to 5 million tons of MAP and DAP from the global market. Just frankly, global demand's not being met. I think we're down probably 3 million tons a year of what DAP and MAP consumption should be. Next slide. So we still have, I think, extremely constructive long-term phosphate fundamentals. As I mentioned, global demand's not being met. Again, we're down 3 million tons. Really, we should be at 30 to 32 million tons of annual consumption. We're closer to 28. And as you think about new supply coming on in the next 5 years, I just think that's just going to make up the deficit that we have been experiencing. And so we'll see where this goes. But and again, more fertilizer going into the LFP sector. OCP has what they call line F coming online in 2028. That's about 450,000 tons of P2O5. The Saudis have 1.5 million tons of P2O5 coming on starting in 27, 28. That will ramp up over about a 2 to 3 year period. And again, this will just help support demand growth as it's needed. And I think there's just going to be a big shortfall as we enter into the next decade. So again, strong fundamentals, really strong, I think, in 26, 27. And if China, to me, I think could end up exporting nothing throughout the next 5 years. So again, this new capacity is going to be needed. This lower incremental supply forces elevated operating rates. If you go back the last 10 years, the average operating rate's been closer to 85%. Now we have to run at 90%. I think everybody's running as hard as they can. But, plants still have to have turnarounds. There's always unplanned downtime, weather events like hurricanes here in the U.S. that impact operating rates. In terms of supply, if you look at OCP, they're making up the shortfall right now with China. But if China went to zero, there's just not enough supply to meet that demand. And I think OCP has also shown really disciplined operating rates. If you go back to 22, when Russia invaded Ukraine, fertilizer prices globally went to over $1,000, which really did impact demand. And OCP reduced their operating rate closer to 75%. So these are just facts. And I think they realize that they are the major player in the world. And I think they'd rather run in full out. But I also think they're looking at their margins and knowing they have huge investments in front of them and they've got to get a return on that capital.
Okay. Can I interrupt for a second?
Sure.
Because there are a couple of questions here. I think There are two questions. I'm going to combine them as one, but what is the current cost structure and margins on your key products? But more importantly, how much flexibility do you have in terms of phosphate pricing? If we see a decline, how much will you be impacted? I guess how sensitive are your margins?
Well, we produce 400,000 tons of MAP. Let's just call that. So every dollar declines $400,000. That's probably a better way to look at that. And we produce about 40% of our offtake goes to superphosphoric acid. So it's about in total, trying to think here in terms of product tons, it's closer to 200,000 tons of product. So again, a dollar declines $200,000. We also have key inputs of sulfur and ammonia. Our ammonia cost, I think over the next 5 years, probably going to be around 450 delivered. It's indexed off of ACO gas in Canada, and that's been fairly weak. Don't see really any strength to that. Our freight rate's about $235. Don't see a big change there. So I think we're in pretty good shape. And in terms of the cost curve, we're not the lowest cost producer, but we're not bad either. If you compare us to the other U.S. producers, as Matt outlined, the key is our operating rate has been close to 100% or at 100%. So our operating margins have been better than our two biggest competitors. But if you just look at straight costs, we're probably middle tier, but we're in good shape. The thing where we benefit is our location. We're located in the Western U.S., and those locations get a better net back than if you were selling and producing in the Gulf Coast. And Matt, if you want to add anything there, if I missed something.
No, that's a really good summary, David. And I'll point people back to slide 5 just on realized EBITDA margin. This year, we have been impacted by the higher sulfur costs, and we have a slide coming up, but still maintaining a margin sort of in that 32 to 33% on a trailing 12-month basis. That's 700 to 800 points higher than Mosaic and close to 1,200 basis points higher than what Nutrien's same time is. And so, as I said, we don't have scale advantages that those guys do. They have much larger facilities, and we are a little more geographically isolated, but our throughput has been significant. And then the other thing is we don't see all the volatility in phosphate pricing because of the nature of our offtake agreement with Simplot. That is priced on a rolling 3-month average of the prior 3 months' prices. And so if there's a short-term blip for say, a month, we don't see the lows. And even to our results year to date, there's significant upside in our pricing as at this end of the second quarter, we were only starting to see the run-up in prices that occurred in Q2 through our contract formula. And that's demonstrated on a slide that we have coming up.
Great, thank you.
Yeah, U.S. trade policy creates uncertainty, but actually it's been positive for our company. If you look at the last 5 years, imports of DAP, MAP, triple superphosphate or NPS has averaged around 2.5 million metric tons. Since the tariff announcement, no phosphate has been imported into the U.S. market and likely short of phosphate going into the fall. I just had a call with our lead sales executive, and he's hearing from people today in the field, which we knew, but we're hearing this anecdotally, that the market is just flat short of dry and liquid phosphate. So I think even if we have some demand destruction, I think it will be more deferral than destruction to next spring, or it just will be supply constrained around the market. So we're still expecting a big fall, and again, nothing's come here since May. We typically would import around 1 million tons, May through December. And so if nothing comes, we have any kind of fall. I mean, the market's going to be on vapor in the U.S., so just nothing here. In terms of crop exports, they've been strong this year with the lower prices. It'll be interesting to see if we get a trade deal with China. The easiest thing, I think, to help balance trade are soft commodities like corn and beans and wheat. And my gut is the fact that China hasn't imported any corn since last fall likely means they're keeping their powder dry. They knew we were planting a lot of corn, big bushels. So by their patience and waiting, they're great traders. they do come back in and buy, they'll likely, get this lower price, but that also means likely a higher price next year. So, and I think as you look around the world, soft commodities again, some of these countries that have tariffs and are looking to balance trade will likely start to import, I think corn and beans, some of these other products. But the major exporters to the U.S., like Saudi Arabia, is a big exporter in the last 2 or 3 years. When countervailing duties went against Morocco and Russia, they kind of replaced them. And right now, they just did a deal with India about 2 or 3 weeks ago for about 80% of their availability between now and December. And just today, they did a deal for another 600,000 tons. So there really just isn't anything left in the world. Everything's is getting committed, and just don't see anything coming here now through fall, through winter, and supporting fertilizer prices where they are. In terms of fertilizer prices, the market, as I said, was very weak in the teens, 2014 to 2020. Then the market really transitioned in early 2021. So we've really had 5 really terrific years from a MAP and DAP pricing standpoint. Only a few quarters where it dipped below $500. But in the last year, we've hovered around $600 per short ton MAP FOB NOLA. Since the tariffs were announced, we started transitioning up in late spring to $700 FOB NOLA. And in the last 6 weeks, it's moved up to $800. And it's firm, I think, through fall, through the end of the year. Maybe it comes off a tad, but I don't think it's going to come off that much. And then one of the big companies that predicts pricing for us for the fertilizer business is CRU. And they actually have MAP NOLA averaging $755 next year. So that would be not a record, but a near record year from a pricing standpoint. And we think it's even firm through 27.
Yeah, one of the questions, David, that just came in was one that was asked earlier about your margins. And it says, pointing to my earlier question, can you still make money at $600?
Yes.
I think what's going to happen if MAP prices were to come off that much, and it's still $600 very profitable for us, yes. But I see sulfur prices probably coming down in tandem. So if prices drop 200, I think sulfur would probably absorb over half of that. But it's still, yeah, we're still in great shape at $600. In fact, that's probably the long-term trend average is probably, my gut is between 550 and 650, as some new capacity comes online. But I could be low on that. But we're still profitable as we've demonstrated here in the first half at that price level.
Thank you.
Anthony, for some recent context, if you take a look in call it Q1, Q2 of this year, and back a little further in 23, we've had multiple quarters at $600 averages and still been extremely profitable.
Yep, great, thank you.
We were fortunate last year with below market sulfur prices, and I think that enhanced our margin. Now, as we transitioned into 2025, sulfur prices kind of went back to historical levels. I think actually they're probably above historical levels right now. I do think they'll transition back in relationship to how they are priced against phosphate. They are down about $20 since Q3. They've leveled off. I think they'll probably stay in that area where we are, $20 below the peak through the end of the year. And then we anticipate sulfur prices come off a little bit in 2026, but likely still above $200 in my opinion. The other thing I would add, ammonia is in that $400 to $500 range in Tampa. I think it's going to stay strong through the balance of the year. But if you look at all the new ammonia capacity coming online, there are a couple of new plants in the Gulf. I think Tampa ammonia is probably going to go below $400 over the next 5 years. But our delivered cost is around $450. And as I mentioned, we're on ACO gas. And at $450, we're super competitive at that level. Matt, I'll turn it back over to you.
Yeah. Next section of the presentation is really an overview of our assets. as we've stated, Conda's the flagship business. It accounts for the lion's share of everything we do. Located in Idaho, it's been in operation for well over 30 years. One of the key things that we've been working on over the last 2 years is the development of our new mine. It's actually two mines, but we refer to it as H1NDR. There's the North Dry Ridge mine, and then there's also the Husky mine. Per the technical report, that has mine life reserves through the middle of 2037. As we go through and develop that mine, I think there'll be potential for expansion of that reserve through good mining practices. In relation to H1NDR, we received our notice to proceed on the mine in May of 2023. The team's done an amazing job in getting that ready. We'll complete operations in our Rasmussen Valley mine, our current mine that we're operating in, stage either in late third quarter or early fourth quarter. But the good thing is we're already mining in North Dry Ridge. The photo there on the left shows the ore reserves that have been pulled out of North Dry Ridge. We're finalising the completion of that project and expect completion some stage in the second half of this year. As I said, the mine is in operation. What is just being completed is the loadout facility, the ore loading project there on the right, and then the final rail and road associated with that project. In addition to that project, we also have what we call a mag reduction project. So in Husky 1, there is a slightly higher magnesium content, and so we're going to make a modification to the front of our processing facility. It's a flotation project that will reduce the magnesium content. That is designed to ensure that we continue to have the same throughput and recoveries of our ore, and so we can continue to produce at the same levels. But there's also potential benefit of giving us a little bit more flexibility to be able to produce slightly more SPA if the market requires it. SPA can trade at a premium to our MAP product and has the potential to do that early in the next decade when another facility in the US that produces that product comes offline as it runs out of ore. On slide 19, if we move there, one of the exciting things from the perspective of the team is really about ensuring that the longevity of our Conda asset. And so we waited on environmental approvals to develop North Dry Ridge and Husky, just given the financial position of the company. We are moving forward on identifying the next mine and the one after that. If you look at this map on the slide, the focus is on the area number 3 called Dry Ridge and Husky 3 and 4. They run adjacent to the Husky mine. We've started exploration and delineation drilling in those permits with a hope that we can get a resource or reserve disclosure around that next mine by 2028 or 2029. There's a wide range on the time frame. It does require us to get all the required environmental approvals to do all the exploration drilling. But so far it's been progressing ahead of schedule, and that's fantastic. The next area after that is the Freeman Ridge and Husky 2 mines. We've started baseline studies there. We're targeting to start exploration drilling out there in 2027 or 2028. The annual program for these areas, this year is somewhere between 6 and 8 million. We'll continue to look at that. But what we're looking to do is to extend the life of the asset well beyond 2037, and we think there's a potential for multiple decades of additional resources, which of course are subject to successful drilling and permitting. If we move to the next slide, an area that's been a pretty remarkable turnaround for us is our Brazilian asset. So Itafos was originally started on the basis of acquiring the Arraias asset out of bankruptcy. It's a 500,000 ton integrated facility located in Brazil. Two successful startups of that production facility really related to the overall quality of the ore. And so it had been mothballed in 2019, 2020, as we looked to do some more work around that. What we have done is begin to start developing or restarting that plant in a very thoughtful and constructive way around doing it to really understand the resource base and to bring it back online, not at its full capacity, but at a reduced rate based on the high-graded ore reserves that exist in those mines. And so successfully restarted the granulation circuit out there this year. In 2023, we restarted fertilizer sales out there. 2024, we sold some partially acidulated rock into that market. And so it's been a very sort of constructive way that we've been able to bring that business going forward. If you go to the next slide, what's really happened is in care and maintenance, this asset was costing us about $3.5 to $4 million just to hold in care and maintenance. Restarted sulfuric acid, as I said, in 22 and 23, which allowed us to pay for care and maintenance. And really since 24 and in the first half of 25, we've seen a significant expansion in our sales, both sulfuric acid and our fertilizer products. There's been really good uptake of those products in the market. And you can see in the first half of 2025, we were able to post $5.4 million of EBITDA. Some of that's been driven by the market. There's some favorable sulfuric acid market prices down in Brazil. But it's really a testament to the strategy down there in Brazil of our team and the execution as they start to move that business forward. The objective is, as we move into next year, is to look at restarting SSP production, which has the potential for us to provide further uplift in the earnings of a Brazilian asset.
Is it easy, Matt, to predict those? Is it easy to predict the trend of where you think that's headed? How confident do you feel that you can continue that positive EBITDA momentum?
Anthony, I think obviously we're in a commodity-based business, so we are effectively price takers. What I can tell you is that Brazil is a market that is in dire needs of fertilizer, and so it will follow the trend of the global market. We think there's potential for that EBITDA to continue to grow. We don't make predictions or we don't provide guidance on our EBITDA going forward. But we do believe there is the potential to sell SSP into that market, which would increase the value of the business.
And Matt, I might add that, Brazil imports about 85% of their phosphate needs and almost 100% of their potash needs. So it's a huge global, it's one of the best export markets for grains and oilseeds in the world, the fastest growing market in the world, but they don't have a lot of, domestic production. So where we're located, it's a great location. We have a freight advantage to the coast. And I was down there in June. Matt was there earlier this year. I mean, the farmers that probably wouldn't give us a time of day a year ago are now all courting us. They all want to talk to us. And the demand for those products has never been better. The margin pricing is going to kind of match globally what's going on, which we see as very constructive the next 5 years. So right now we can't make enough granular. I mean, it's going really, really well. And I see a great future for that site. And we're now running the higher quality breccia and conglomerate rock, which makes these products. We think we've got over decades of resources there. And so we're excited about the future. And that team is just doing a great job, really introducing new products out of that operation. So can't say enough good things about those guys.
And how much bandwidth do you have in order to ramp up production down there?
Anthony, we think that, and we're still optimizing this, that it will make sense probably to run it at about a third of its capacity, maybe a little bit more. There are implications if we run much harder than that, including having to restart tailings dams and things like that in Brazil, which aren't always favorable. And so we're still doing that work around optimizing it. But if you ask today, it's probably somewhere in that 35 to 40% of the 500,000 capacity of that plant.
Man, I would add that, our thinking a year or two ago was we would just run the SSP, but the success of this DAPR, PAPR, and granulated PAPR is going to be close to 150,000 tons probably this year. our thinking before was those products may go away, but we think now with more conglomerate rock, we could sell the SSP plus the other products. So, I mean, my goal would be to get that plant up to 300,000 tons of all products. So of fertilizer products, excluding sulfuric acid. So we're very excited about that in
Yeah,
the future.
that's fantastic. Thank you.
If we move to slide 22, just the overall other parts of the portfolio. As I mentioned in my comments earlier, we sold a rare earths project called Arraias last year to an Australian listed company. It was a combination of cash and equity in that business. We received $10 million on the completion of that sale. We have 2 additional payments to come, $6 million in the fourth quarter and another $5 million in the third quarter of next year. As part of that sale, we did declare a dividend, our maiden dividend, to shareholders. And so that was a reward for that part of the business. As I mentioned, we took 10% of the equity of the company that purchased the asset. We continue to be shareholders of that. The team who purchased the asset have aggressively been moving it forward, including getting environmental studies and drilling completed. And that equity value has appreciated since we completed the sale. In addition, we have 2 other assets that we continue to look at, and they provide great optionality. Santana is one of the highest graded phosphate resources in Brazil that's undeveloped. It would require significant capex, and so we're starting to think through how that development might look like, and whether there's an opportunity to bring that forward, look at our options around our equity interest in that project, the potential for others located in that area maybe to participate as well. And then finally, Farim, it's an undeveloped resource in Guinea-Bissau in Africa. It has one of the highest ungraded, undeveloped resources anywhere outside of Morocco. Extremely good quality rock. The difficulty is it's located in Guinea-Bissau, which is a pretty immature in sort of African nation in terms of its infrastructure. We have an NI 43 that was completed in relation to that project. It would require significant development as well. Part of the job that the team's doing this year is really to think about alternative ways to develop that asset, also to find potential partners in that project, whether it be via offtake or participation in interest in it, or even potentially, if the value was right, an outright sale of that project. David mentioned he's going to China. Part of that is to talk about this undeveloped resource base. Changing gears, if we move to the financial results, we've talked about our operational performance, our utilization. I do want to call out and celebrate the team in terms of our overall safety performance. It's pretty remarkable where that safety performance has been, not only for the last year, but really over the last 4 years, as the team has an amazing culture about making sure that things are done in the right way and a safe way. Production was slightly higher Q2 compared to Q2 24. That was primarily due to the fact that we had a long planned turnaround in relation to our Conda facility. We do annual maintenance programs out at Conda every 3 years. It's a long turnaround. The duration for those is somewhere between 23 and 26 days. And it's really a commitment that we've made around investing in our asset and the infrastructure that's allowed us to continue to utilize those assets, like we displayed earlier. In terms of our capital allocation, maintenance capital has never been shortchanged in this business. It's paramount to everything that we do. We obviously then have to fund our growth capex, our asset retirement obligations, and really, starting to generate and have delivered the balance sheet. And now we're in a position where we can start to think around capital allocation and returns to shareholders. On slide 25, we've provided our financial outlook and our guidance. Guidance has been reiterated. Business has been continuing to perform really, really well. And no real changes to this from the start of the year. We think things are progressing well, and we expect to have a really robust second half of the year, given the increase in pricing. And just to summarize, just a reiteration of the sort of the core strategy of the business. It's around operating excellence, high utilization, disciplined investments, and about making sure we execute on our capital projects, and then looking at high grading the portfolio, looking for optionality around realizing value for that. And now, as we move through the end of the elevated CapEx period, starting to think about what capital returns might look like for our shareholders. Anthony, with that, I might turn it over to you to address some of the Q&A.
Yeah, thank you. Great stuff. We already have a bunch of questions in queue. If you have a question, type it into the Q&A or chat box. We do have one of our attendees raising their hand. Go ahead, Calvin.
Hi, it was a great presentation. Thanks. When I was following the company a few years ago, does Castle Lake still own a big chunk of the stock?
They do. They still own about 2/3 of the business.
Yeah, they were looking to sell it at some point. It was kind of putting pressure on the stock, so it never really got the multiple. Are they still looking to unload the block?
Yeah, look, Castle Lake has been a long-term investor in the company. We did run a strategic review process in 2023. In hindsight, it may have been a little earlier than we should have, just given the nature of the capital that we had in front of us. After we launched, pricing for the product did go down, but we're also in a period where we had to really demonstrate that we could get the new mine up and running. Castle Lake aren't required to sell. They're not driven by a fund timetable. They certainly don't think that this is an appropriate price to sell equity at. I think, over time, they will always continue to manage their own portfolio. But they also see that the business is really on the horizon of being able to generate significant free cash flow, probably in the next 24 months, that potentially provide them with an avenue to continue to get returns via shareholder returns from the business.
Okay. All right. Thanks for the update.
Thanks, Calvin. Okay, so we're just going to go and down these rapid fire. Some of them you may have answered. Some of them we can get to. So if you could go back, John, to slide 19. Let's see, is the land controlled by other companies in that area? And talking about Simplot, Nutrien, and Bayer, are those in production? Are they potentially for sale? What's the status of those packages, land packages?
Yeah, sure. So Simplot is a producer of phosphate. They're currently operating. Bayer produces Roundup out here. They have a new mine that's in development. They're currently mining in Blackfoot Ridge. They'll move hopefully to Caldwell Canyon, and really they're in the middle of getting their environmental approvals reaffirmed in relation to that. Look, there's always the opportunity for third-party discussions around potentially, commercial deals, whether that be something like purchasing ore from them or swaps, outright purchases. We don't have any disclosures around any of that right now. But clearly there is the potential to find a commercial solution that may add even further resources to what we have.
Great, thank you. Have you considered a regular dividend, even if it is small, or is it too early?
We have a pretty significant CapEx profile ahead of us. We haven't provided 2026 guidance, but it's likely to be in the vicinity or if not higher than the current year. And so we're mindful about de-risking that part of the business first and ensuring that we continue having capital to maintain our assets. The key, Anthony, around that is, obviously we've talked about our exposure to pricing. I think if prices remain robust, We may be able to accelerate that discussion as the projects become de-risked and we continue to build capital. So it's a little preliminary, but it's certainly something that I think becomes more of a priority if these prices remain.
Thank you. Does all the products stay in the United States?
Yeah,
David, do you want to handle that one?
yeah, it does. We ship a little bit of product into Canada, but our MAP offtake, as we mentioned, is with Simplot, and we don't know exactly where they're taking that product, but we know it's mostly in the Western United States, Western Corn Belt, West Coast, and a little bit into Canada. 95% of our super acid stays in the United States. It's primarily for corn. It's a what's called a starter fertilizer. And as you go through the Midwest, springs are usually cold and wet. So this poly is put right next to the seed and it allows the seed to germinate and get off to a good start. But the answer is yes, most of it stays here.
Great. And I think you touched on this earlier, Dave, but one attendee is asking, assuming tariffs aren't an issue for you at this point.
They're not, the sulfur and ammonia we bring in from Canada is protected under the USMC agreement. So there's no tariff on that. We've got a little bit of exposure in our mag reduction project over the next 2 years, but it's probably no more than $3 million of bringing stuff in from other parts of the world. But that's about it. We're in pretty good shape. I mean, we're really, as I said, favored on the tariffs on the exporting countries of phosphate that have been coming to the U.S. That's not coming today, not coming this fall, and maybe it doesn't come next year either. So we'll have to watch that closely. Now, what it may mean is Mosaic exports less, but the predominant share of where those exports go are in Canada, where the product's needed. They've got really good logistics, and into Brazil, where they have a big distribution system. So I just don't know how much they can cut and stay in the U.S. So it looks like to me the market's just going to stay tight to short through the foreseeable future.
Great. You kind of answered this question earlier, but I don't know if you want to elaborate. But this attendee asked, wanted to get this question in the queue. I saw a post on X that your valuation is about 50% of your peers. If you could elaborate, please. So I don't know if you want to shed any more light on that. I know you discussed it earlier, but feel free to add to it if you want.
Yeah, look, I think the numbers speak for themselves, Anthony. The capital structure that we have with Castle Lake owning 2/3 of the company certainly has an impact on our liquidity, and that's certainly a factor in terms of just I think where we sit relative to our peers. Castle Lake's well aware of that. I know there's another one in the queue, Anthony, about listing and whether we would consider a US listing. What I'd say around that is all of those things are being analysed. Really trying to find a reason to drive a US listing would be helpful if we needed to do some form of capital raise. As I said, the majority investor certainly doesn't think that this is a valuation that's reflective of the business, and I don't think they would intend to sell down at this price. But all of those things have an influence on where we trade. And we do look at, are there alternatives? I do think it was a positive first step to move to the OTCQX. We have seen that be successful so far. So all of those things are being considered.
Yep, absolutely. And the QX was a great start. This is a question about Araxa. How big is it in terms of what would be needed for that in terms of CapEx? Like in your opinion, I know it's kind of early. Does the acquiring company have the ability to push it forward, and would you offer any financing help?
Yeah, we wouldn't finance that project for them. Look, they're a junior miner on the Australian Stock Exchange. They recently tapped the market to raise some capital to drill out there. It's certainly a 9-figure capex number. We don't have privies to what their development plan would look like. But I think as they move that project forward, they'll look for potentially strategic partners or other investors to help sort of move that forward, but it does take the path of a sort of junior mining company.
Mhm.
And we like that exposure. It's not something, we're not a rare earth producer. We don't have that expertise. It wasn't core to our portfolio, but we do see potential value associated with that. And that's why the structure of, retaining some equity in the business was a structure we wanted to pursue.
Yeah, absolutely. What is the 5-year plan? Your company would make a great acquisition target. I mean, obviously, you know, with Castle Lake owning most of, the shares, any acquisition potentially would have to make sense to them, obviously. But what is the 5-year plan in terms of where you see Itafos trading?
Man, let me address that. I would say right now we're really focused on the next 2 years of de-risking our CapEx. We've got to finish out H1 NDR, which is probably 90% complete today. Mag reduction is just starting. That'll be complete in 27. And then we have our ARO, asset retirement obligation for Ras Valley. So we'll be spending some cash there. So that's important. I think the other thing is just continuing to grow our Arraias project, get the beneficiation circuit up and running here at the end of next year to run SSP in 27 and see their EBITDA growth there. And then, we would look at Farim on a maybe shared basis with the right partner and a low cost CapEx basis. I mean, that's very preliminary. There's a lot to do. I mean, nothing may happen there either, but if we could develop that, knowing globally it's one of the best rock reserves in the world, and develop that on a low risk basis, we would consider that. And then Santana is north of Arraias. It's the best quality rock in Brazil. So how could we, on a low cost, low risk basis, start to develop that and maybe introduce the same products that we've developed at Arraias? So, go from really one working asset now to two. Can we make it three, then four, and just continue to grow the company? But again, we're going to be very disciplined on what we do. We'll have to have the support of our board of directors who've been super helpful the last 5 years, helping us direct the capital to the right places, getting this company in the shape that it's in today. So, but we're a great company. So, I think if somebody's willing to pay a multiple that's more reflective of the industry, and that's where we want to go if somebody wants to buy us.
Absolutely. I think it would be a great acquisition candidate for a larger company for sure. Last question, we've touched on this. I don't know if you want to shed any more light on it. So would you say at this point, I guess commodity price is your biggest risk? And I think Dave, you mentioned earlier your long-term view of pricing.
Yeah, I mean on MAP itself, as we said, we're indexed against NOLA. So with no imports coming, I think pricing is super constructive next year. Again, CRU is estimating 755 as an average for the year. And I think if you talk to anybody, it's super constructive on 27. We've got a little new capability getting built out 28 through 31, but those tons we need to really meet what is normalized growth around the world. So I don't think that's going to have a big dip on prices. And maybe we're back to more of this $600 level, later on down the road, but it's really hard to predict. But, I think the other wild card is China just going to completely back away from exporting anything? And I'm not saying they will, but the whole market was surprised this year that they went from, 7 million, 10 million tons to 7 to 6.5 to, down to 3.5 this year. And, that extra 3 million tons just can't be made up anywhere. So, I'm very, very, positive on the sector in phosphate. Historically, it's been an extremely tough business, but I think after decades of a tough business, I think we're finally in a period that phosphate is probably the premier nutrient of the three, nitrogen and potash. So I think phosphate's the new leader. And it will remain that until, we just see enough capacity. And we mentioned yesterday, you guys didn't hear this, but one of our competitors, they have a facts book, and they say it's $6 billion to build a vertically integrated million-ton P2O5 plant. And it's incredible. That's so expensive. So number one, you've got to have availability of rock, a lot of rock. And you got to have the ability to do that. It takes a long time to build out. So I think, it's going to be a while before we see a surplus in the market. And I think the next decade, we need a lot of new capacity. So if you look at the CRU numbers in the 2030s, 2040s, they're pretty close to where we are today, because that's exactly what it would take to build something new. So super constructive on our future.
Yeah, absolutely. And I think that's a great way to end the presentation. I want to thank David, Matt, and John for coming on today and bringing everybody up to speed on the company. Obviously, a lot of great things happening, very strong balance sheet, a lot of optionality with their portfolio. Management team obviously knows what they're doing. It's been an amazing turnaround the last 4 or 5 years, and I really encourage everyone to take a long, hard look at the stock.